For joining today. Target date funds continue to grow, and they have a clear outlook for growth. And because of that clear outlook for growth, the competitive landscape and just the landscape in general is continually shifting and evolving. And so today what we're going to do is we're going to go over the key findings from our 2017 Target Date Fund Landscape Report that we published in late April. And so what this report, the background on the report is, so what we do as a multi-asset team, we have about 7 or 8 analysts that cover target date funds, and this every year we have an opportunity to just take a step back and just explore the landscape in general, and to answer questions that we might have, that investors may have, on what's going on with the target date funds. And given that we use that questions format, we actually formatted this year's landscape report in an FAQ format, so answers to frequently asked questions. And so ultimately the report had about over 20 questions covering different aspects of target date funds, and we dug in and tried to find answers to those questions, and we'll be presenting those findings in this webinar. The questions generally fell into 5 general categories, and we'll be going through each one of those. And so the first one we'll be touching on is the asset flows and the competitive landscape, basically what's going on in the current trends with target date funds. Then we'll touch on the target date experience, so the target date investor experience, so really focusing on the perspective of the person who is investing in target date funds. Well, fees have been a big aspect of target date funds, or a lot of attention to fees. So we'll spend some time on fees, and then we'll finish up by touching on the evolution of target date funds. So basically how they've changed over time, and also finish it off by looking at what the next frontier, where we see target date funds potentially evolving going forward. So I'm going to hand it over to Susan Wasserman to discuss the trends with assets and flows.
Thanks, Jeff, and thanks again to everyone who's joining the call today. So on slide 4, and actually maybe before I jump in, so I'll walk us through some industry-level statistics around asset growth and highlight some of the key multi-year trends we've seen. And so if we just start with slide 4, we see a pretty clear trend, and that's that target date funds continue to grow, as Jeff mentioned earlier. Target date tend to be the default investment option within DC plans, so assets are pretty sticky. In this year's report, we estimated that there were roughly $60 billion in net inflows in 2016. That's down by about $10 billion from 2015, but do keep in mind that we're looking just at open-end funds here, and we do know of a few series, such as Vantage Point and Wells Fargo, that moved assets from the mutual funds to CITs. So overall, organic growth is still solid, and there really aren't any clear indicators to suggest that this trend will reverse. If we jump to slide 5, the fund world tends to be characterized by active or passive, so I think we'd be remiss if we didn't highlight exactly where this influx of target date assets is going. I should point out, however, that we on the multi-asset team here at Morningstar, we don't see target dates as active or passive. We believe that designing the glide path and sub-asset allocation is really an active decision. So when we make this distinction here between active and passive, we're really referring to series, whether series invest predominantly in active funds or predominantly in index funds. What we've seen over the last 2 years is a strong preference for passive funds. This has almost completely reversed the trend from a decade ago, when active target date series really drew close to about 75% of net assets. And if we jump to slide 6, what we see is that as a result of this, the percentage of assets in active series and the percentage of assets in passive series have converged. As of December 31st, 2016, active strategies made up about 60% of the market, and passive strategies made up the remaining 40%. So yes, active strategies still do make up a larger part of the market, but that share has come down by about 20 percentage points over the last decade. So on slide 7, I think if we just kind of take a step back and look at the larger fund ecosystem, we see that target dates can really be important to asset managers. Just to highlight a couple of firms here, about 30% of assets at T. Rowe Price and 30% of assets at TIAA are in the target date series. So T. Rowe's target date funds had positive net inflows, but the firm overall had outflows, and TIAA, both at the target date level and across its mutual fund lineup, had positive inflows. So target dates can really help to ameliorate some outflows or help to contribute to growth. So from here, I'll turn it back over to Jeff to discuss market share.
And so there's always questions on looking at the competitive landscape of target date funds and who are the major players in this space and what's changing in the competitive landscape. And so as a background, there's been the big three, as we call it, in terms of the major players, and that would be Vanguard, Fidelity, and T. Rowe Price. And those three asset management firms represent over 70% of assets in target date mutual funds. And then you generally have those big three, and then you have a long tail of asset managers that have a much smaller percentage of assets. So one of the questions naturally is often, well, why are those big three, or how have they gotten to be the big three? And a few things that they have in common is that all three of them have arrived fairly early to the target date scene. Vanguard was the latest of the three when it launched its target date funds in 2003. So all of them were in advance of the Pension Protection Act of 2006, which really served as opened the floodgates for target date funds adoption and as a default investment in 401k plans. And also, all three of these firms also have record-keeping businesses, so they already had a traction in the defined contribution world or presence. So, but it is notable to note that a few of these have increased their market share in recent years. American Funds and JP Morgan both eclipsed that 5% market share mark in 2016, and also TIAA Crest actually grew its market share in 2016 as well. But when you take a step back and look at the big three on slide 9, you can see that the mix between the market share split between the big three has changed over time. So early on, about 10 years ago in 2006, you can see Fidelity at $64 billion in target date fund mutual funds actually had more than both T. Rowe Price and Vanguard combined. Fast forward the next 10 years, and you can see that by the second half of 2014, Vanguard eclipsed Fidelity as the largest manager in terms of target date mutual fund assets. And all the lines at the bottom of this graph, I know, and I realize they're all muddled, but and it still serves a purpose in showing a point. And one of that point is that it's been a tough time to gain market share. It's not guaranteed that just because you're around that you're going to gain market share, because as we saw at 2006, 5 of the top 10 target date managers in terms of assets have fallen out of the top 10 years later, and actually. Those same 5 none of them have more than $10 billion in target date assets, whereas you can see like Vanguard's approaching $300 billion in target date assets. So it's been difficult to capture market share for some target date managers. And so it raises the question, well, do new entrants really have a chance in the space? And that goes on to slide 10. And the answer is yes. It's been difficult. The answer is it's been difficult to gain traction, but target date managers continue to try. And this chart has showing a couple different things. So I'll walk through a couple of them. So the bars indicate as target date series as when they launch and when they are liquidated or merged with another target date series. So you can see early on, around 2005 to 2008. That's when you really saw a lot of target date funds come into market. So again, the Pension Protection Act of 2006 really served as a boost to target date funds in general because it became a default. And as a result, a lot of asset managers attempted to get into that market to capture some of that growth by launching target date series. And as you can see, then the financial crisis happened in 2008, and so you saw launches cut back, and you actually saw some funds target date series go away. But over the past few years, it's been a split. We've typically seen a few come and a few go. We haven't seen a mass exodus of target date series, or we haven't seen a ton of new launches. But it's a pretty steady of launches and subtractions. But the interesting thing is when you look at the lines, which tells another story in terms of back in 2006, you can see by the yellow and the orange lines that through 2002 to 2007 or 2008, these lines are the yellow and orange lines are pretty much on top of each other. So what that really is indicating that target date managers came to market with a single strategy, because the yellow lines is the number of series available in the universe, and the orange line is the number of target date managers in terms of the firms that are managing target date funds. And you can see up until 2008, those were pretty much spot on to each other, because target date managers were coming out and saying, this is our approach to target date investing. Here it is, and trying to convince investors of that philosophy and approach. As you can see, though, those lines have since diverged, whereas the number of target date managers has hovered around 40 over the last 5 years. You can see that number of target date series has actually grown. And so what you're seeing is that back in 2006, there wasn't a single target date manager that offered more than one series. But now there's actually 12. But that doesn't mean that those, not necessarily a guarantee that you're going to get assets just because you offer more series. And what we've seen is that actually out of 10 of those 12, more than 75% of the assets still sit into one one series, and so it's not spread equally across the series. And actually 5 out of those 12 have more than 95% of assets in a single series. But we have seen that when you look at the flows is that you can see that one way that target date managers can branch out is by offering a index-based version of their target date strategy. And we have seen that index-based offerings are generally gaining more interest than the active-based ones, even within their firms that still have most assets with that active series. And that would be the case with the Fidelity Freedom Index, and the mutual funds actually saw positive flows in 2016, whereas the legacy Freedom funds were in negative outflows. So we have seen that trend. Now jumping over to the target date investor experience, I'm going to hand it back over to Susan to talk a little bit about how target date funds, the investors have experienced it on slide 12.
Thanks, Jeff. So a really big question we're asked, and we ask ourselves, is whether target date funds are actually working for investors, right? So if we consider that we're not that far into the life cycle of these products, considering that if we think of BlackRock or the former BGI started its target date series less than 25 years ago, and target dates really didn't take off until 2006. We don't have particularly long track records to work with, but there are some metrics that we can point to that suggest that so far investors are benefiting. So the table on slide 13 breaks down the mutual fund industry into pretty standard large asset classes, and it shows 10-year total returns and 10-year investor returns for each bucket. So the total return is your standard total return calculation, and the investor return nets asset inflows and outflows, and it's probably what you would consider your dollar-weighted return. And so what we see is that target date investor returns are greater than total returns, and come out, ahead compared to a lot of other asset classes, and which means that investors are benefiting from sort of the buy and hold, set it and forget it approach. Another question is whether the to versus through distinction has an impact on performance. And the answer is that that distinction alone doesn't dictate performance. So in this table, we've taken 2020 and 2040 to and through funds and averaged their 3, 5, and 10-year ranks. And we've also added in the average equity allocation in the last column. And what we see, kind of the big punchline here, is that it's really equity allocation that's important. And that's kind of to be expected if we consider that the equity markets, particularly your domestic large cap equity, which tends to be the biggest part of a glide path equity exposure, has done much better than your core ag bonds. We've kind of come to this conclusion just based on that information. And slide 15 just sort of reiterates that point. Here we've regressed returns on return ranks on equity exposure, the expense ratio, the series allocation to active underlying funds, and the series allocation to funds that are outside of the manager's platform, so open architecture. And what we see is that the higher equity allocation is meaningful. So each additional percentage point would lead to a lower performance rank. So the sign here is negative because lower performance ranks are better.
Okay, and from the perspective of the target date investor, is to gauge whether target date funds are working or not. Oftentimes the comparables would be the other qualified default investment alternatives. So again, while the Pension Protection Act of 2006, target date funds were one of three qualified default investment alternatives for defined contribution plans. The other two were managed accounts and balanced funds. So in our research, we didn't address managed accounts. Just given their customization, it's hard to have a broad evaluation of how managed accounts are doing. So we bypassed the managed accounts, but we did want to highlight or provide some comparison on how target date funds have fared versus balanced funds, and typically looking at a 60-40 balanced fund. And so as seen on slide 16, you can see that the balanced fund has actually done better in terms of performance, a higher return out of these subset of target date categories compared to the 50 to 70% equity category, which where a 60-40 balanced fund would sit. Only the retirement category actually had a better Sharpe ratio, and the 50 to the 60 the balanced fund had the higher return. So the question is there something deficient with target date funds that make them inferior to like a balanced fund? Well, the target date funds generally tend to be more diversified, and they tend to hold more in non-U.S. equities, and that has been a major component in looking over in this time period as non-U.S. equities haven't kept pace with with U.S. equities. So it's more of a structural headwinds for target date funds at that point. And it is interesting, though, when you do this type of analysis, it basically assumes that it's like you buy and hold it at the beginning, and then you hold it, and then you reevaluate it 10 years after. But the reality is that target date funds aren't used like that. They're usually used as an investment, and investors continue to contribute to it on a regular basis from contributions from their employer and themselves each paycheck. And so there's continual contributions. So what we want to do is look at, like, well, how would the investor experience be with those balances? And on slide 17, it shows an interesting thing, that the higher returns over that 10-year period that we saw for the balance fund didn't necessarily always translate with a higher balance for those relative to those target date fund categories. And so we used the scenario where we estimated starting salary, estimated growth rate of that salary, estimated contributions to create like a hypothetical scenario. And what we found, and then we looked at how that simulated scenario would have done with using the different investments and investing in these different categories. And you can see in this chart on the far, the orange chart on the far right shows that the 60-40 balance fund in that category would have been about a $67,000 balance at that point, but which is actually a little bit lower than the 2030 to 2050 funds. And that's a result of some of those categories have done better in recent years when balances are actually higher. Which leads into the next point, where the balance actually for an investor, targeted investor, their balance and the size of their balance plays a big role in how the performance will affect their outcome. And so on slide 18, you can see we did a similar scenario analysis in an attempt to examine should investors, when they're evaluating performance, emphasize a certain part of the glide path more than another. And what the results show, and it's not a surprise, but the results have a much greater effect when the balances are at the highest or near the highest. And we thought this example would just help show that I mean, it's an intuitive thing, but a concept, but it's just an example to capture the magnitude. And so we looked at two examples of a 30-year-old versus a 60-year-old, again using a hypothetical account, and see what their beginning balance is, and then compare how, if they had 5% return or a 10% return, for how it would affect the balance. And you can see that whereas a 10% return, if you aggregate the orange and green numbers, for the aggregate would have been about $16,000 for a 30-year-old. That's how the balance would have changed. If you got that same time-weighted return when you're age 60, that'd actually be a $400,000 addition to your balance. So you can see, comparing that $16,000 versus the $400,000, is that there's good reason for investors to really pay close attention to how the funds near retirement are doing, or how they can their growth potential and also their capital preservation potential. Because what we found, and it's apparent on slide 19, is that there is quite a bit of return dispersion among these target date fund categories. So it's typically 5 to 6 percentage points, and it doesn't narrow down much when you get to the retirement income category. So even across all categories, you're still seeing quite a bit of dispersion in returns. And so one thing we did in the report was we looked at how different target date series would do under a scenario analysis, particularly focusing on 2020 funds. And the results are in the full report. But we found that at age 57, using the hypothetical scenario, an investor would have had about $530,000 saved up. Over the next 5 years, depending on what series they could have ended up with as much as $860,000 if they went with the T. Rowe Price 2020 fund, or they could have ended up as low as $684,000 in the balance if they were in the PIMCO Real Path series. So the results can be very different from one another. Moving on, it's very important that fees have been front and center on target date investors' minds. And Susan's going to highlight the current trends with fees.
So there are a number of factors that are putting pressure on asset managers to lower fees. There have been a few lawsuits. There are sort of expectations of what will come of the fiduciary rule. So we're seeing a continued drop in fees. At the end of 2016, the average asset-weighted expense ratio was 71 bips, which is 32 basis points down from 2009. And this calculation, just for clarification, is just a simple average of each series asset-weighted expense ratios. So we were looking at 58 series for this, and each series got a weight of 158 in this calculation. And a few things can cause fees to go down. So the fees on any single series could go down, because the management fee or required fund fees go down. Cheaper series might enter the fold, and expensive series can end up exiting the industry. Our full report has what happened between 2015 and 2016 for each series that we were looking at, but some examples just to highlight would be BlackRock, the LifePath Smart Beta series, where fees there came down by roughly 33 basis points, and the JP Morgan Smart Retirement Fund series, where fees came down about 15 basis points year over year from 2015 to 2016. And on slide 22, I should point out that while the industry average is 71 basis points, the typical investor is actually probably paying much less than that. So this exhibit averages the market share weighted expense ratio. So instead of each series getting an equal weight of 1/58, larger series get larger weights. So, for example, Vanguard, which makes up about 32% of the market, gets a weight of 32% in this calculation. And that helps to drive fees down because Vanguard's expenses are, average about in the low teens. So on slide 23, we discussed earlier in the presentation that equity exposure has really been the most significant predictor of performance over the last decade, but we know that we can't overlook fees. In this table, we show the results of our success study. So the study focused on the cheapest share class available from a target date series, and this is based on the net prospective expense ratio of 2020 and 2040 funds at 3 separate starting points. So the beginning of 2007, 2010, and 2012. So it's trailing 10, 7, and 5 years. We grouped those funds into quintiles based on their starting expense ratio, and the funds with the lowest fees placed into the first quintile, and so on and so forth. So performance through 2016 was then compared with the typical category peer, and the average performance rank is based on funds that survived the entire period. So what we ended up finding was that cheaper funds tended to survive. But from a performance perspective, the funds in the cheapest quintile generally outperformed the most expensive ones, but funds in the middle quintiles, the results were just kind of mixed. So if we go back to the equity point we've made a few times throughout this presentation, there are a few examples of series where, again, we see higher equity exposure that has led to higher performance ranks and sort of overcomes the fee hurdle. So John Hancock Multi-Manager, MFS Lifetime, the Schwab Target series were three of the most expensive 2020 target date funds in 2007, but they also had some of the highest equity exposures, and they have strong 10-year trailing ranks through December 2016. And slide 24 just sort of drives that point home. We found that a 1 percentage point increase in equities coincided with a 6 basis point annualized improvement in performance, which means that, again, higher equity exposure can overcome higher fees. And that can be particularly prevalent in the shorter date and retirement income funds where there is a wide dispersion between equity exposure.
Okay, and so to move on to the evolution of target date funds, target date funds, they came on the scene in the early 90s, but as we've mentioned multiple times, it's really the Pension Protection Act of 2006 that really served as a boost to their growth. And as you could expect, that you've seen significant changes in how they change over time or how they have evolved. And so we'll spend a couple minutes talking about some of the observations that we've seen in the evolution of target date funds. The defining characteristic of target date funds is often the equity glide path, the change in equity exposure over time. And what this table shows on slide 26 is the strategic equity glide path. And as you can see, so it compares the 2016 average versus the 2012 average. And you can see that they're not drastically different. One question we often get is, have target date funds become much more conservative given the experience in the 2008 financial crisis? And the answer is really not really. In general, target date funds have actually generally assumed more equity exposure. And on this chart, you can see that the point where there's been the most increase in equity exposure has been for mid-career investors. So it was about 3.3 percentage points more at roughly 20 years before the target date. So that'd be intended for an investor that's 45 years old. But it is worth noting that the retirement phase, so after the target date fund, after reaching the target date, has stayed roughly the same. So there hasn't been much change there. Now, just because these averages haven't seen drastic differences doesn't mean that there haven't been individual series that have seen significant differences over those last 5 years. I mean, we've seen specifically with like a couple of the prominent ones that have seen changes have been the Fidelity Freedom and the BlackRock LifePath target date series, and each of those saw as much between like 15 to 20 percentage point increases in equity somewhere along the glide path. So there have been changes, but generally the change has just been slightly more for the mid-career investors. So, and on slide 27, we highlight a sub-asset class glide path. And so a couple years ago, we introduced the sub-asset class glide path in addition to the strategic equity glide path. So what the sub-asset class glide path is, it looks at all the underlying securities, not just the funds, but actually all the underlying securities, and buckets them into 10 sub-asset classes. And so we can get a sense of how the sub-asset class mixes on average. And so, and this also allows us to do a comparison to see how the sub-asset class has changed over the last 5 years. And so on slide 28, it shows that the same general trend as what's seen with the strategic equity glide path, that equities have generally increased. And so the equity exposures are captured by the blue and purple lines generally, and all the bond ones are the oranges and the yellows, and the cash is green. And so you can see generally anything above zero, the midpoint zero, reflects an increase from 2012 to 2016. And you can see that generally the blue lines are on top of that. So there could be a few reasons why the why the sub-asset class shows a higher increase than the strategic equity. It could be there's tactical decisions often made with target date funds, so they could be having a bit of that. They could be equities have done well over the last few years, so that just the fact that they've appreciated and maybe they haven't been rebalanced as quickly could be contributing to that. But it shows a similar thing that the increased peaks are at the 2035 fund, so it coincides pretty closely with the 20 years before target date as being the point of the most increase. And this chart also shows that the biggest increase has been in the U.S. large cap space in terms of where managers have added. And the following chart on the next page shows that it just aggregates all those blue lines together, so all the equity exposure. So it just basically captures that if you look at the peak of the mountain, it would be at the 2035 fund. So that's where target date managers have most likely increased the equity exposure for their target date series. And it makes sense why that's the area where you're seeing the biggest increases, because early on in the glide path of the 2060, 2055 funds, often managers are up already pretty high and similar in terms of their equity exposure. And at retirement, there's still in the retirement phase, there's still the caution of assuming a ton more risk for investors in your retirement. But in that mid-career investor seems to be the spot where target date managers appear willing to add equity exposure. And so, taking this perspective of looking at sub-asset classes, we were able also to slice and dice it by active versus passive series. And so the next chart shows basically a question in our mind on slide 30 of how active series have looked versus passive series. So we put all the sub-asset classes for the active series and all the passive. And so anything on top of the zero, above the zero, shows that the passive series generally holds more, and anything below zero shows that active series actually holds more of that asset class. And as you can see, many of the asset classes are pretty similar. They fall within that 2 percentage point plus or minus relative to each other. But where you can see a notable difference is that passive series do tend to hold more in core bonds than passive series and then active series, whereas active series tend to have more in tips and have more in high yield bonds. So particularly as you get closer to the target date. So there is some nuances on what those the sub-asset class mix between active and passive. We're also able to look at the differences in the series relative to one another, on how series compare relative to the average. On slide 31, it shows, and I wouldn't emphasize too much what the scale, what the actual numbers mean on the left-hand column, but more so emphasize the trend, what you're seeing here. Because what this is basically summing all the differences from the industry average sub-asset class glide path that series have. And so across each vintage. And what the chart is telling you is as you get closer to the target retirement date, at 2015 you actually have the most difference is from one another relative to that industry average sub-asset class glide path. So that's an important thing to note, because what it's telling you is that target date managers really aren't arriving at a consensus of saying that this is the optimal mix and everyone's going to adopt the same optimal sub-asset class mix, because there are really significant differences along the glide path. And we did the same look through on the next slide, showing how passive series versus active series, and that we found something interesting on slide 32 that shows that by looking at showing that the red bars are generally higher than the blue bars, is indicating that passive series are actually more different from one another than active series are different from one another, which is kind of counterintuitive when you think of other asset classes and what you're trying to get out of passive exposure, which is general exposure at a low cost. You can actually see that the differences in sub-asset class mix is actually significant with passive and active target date series. And maybe to hit that point home, an example on slide 33 is just comparing two prominent passive target date series. One would be the Vanguard Target Retirement Series, and comparing it to the BlackRock LifePath Index Target Date Series. Again, both these invest in index funds, stick to index funds. But you can see here that there's notable differences. And so, again, above zero shows that Vanguard holds more. Below zero, that shows that BlackRock holds more of that asset class. And you can see Vanguard holds much more, particularly as they get closer to the target date, of foreign bonds, that orange line. Whereas BlackRock, on the other hand, shows that with the light blue other line, other equity, which reflects their real estate exposure, their REITs exposure, that they hold more in that asset class than Vanguard. And so what you can see is that, as Susan mentioned earlier, that even passive series, there can be significant differences from one another. And as a side note on slide 34, this is an example. We for all the target dates, you can provide this kind of comparison. So this is an example of the sub-asset class, because we calculated the sub-asset class for all these target date series. And you can compare them relative to the industry average simply by a chart that like we've been going over. And this is an example of the Fidelity Freedom series. And see where they're overweight and underweight, and when they're overweight and underweight certain asset classes relative to the peer. And we included all this in the appendix 2 of the full report. So of the target date series that we cover, the 20-plus target date series that we have analyst coverage, we included these charts throughout in the appendix. So in addition to glide paths, the question often arises on on underlying funds and underlying exposures. And one question that we commonly get on slide 35 is whether alternatives are getting traction in target date funds. And the answer is no, not really. As you can see in this chart, what this chart shows is that number of target date series out of the 58 target date series that were around, mutual fund series that were around at the end of 2016, only 7 of those 58 actually had a fund that what falls into one of the Morningstar's alternative categories, and actually came down from 2015 when it was 10. And what we found here is that usually it's small players that are using alternatives, so it's not your big three that are investing in alternatives in their target date series. Principal is the largest and it has about less than 3% of market share. And oftentimes the allocations to alternatives is rather small as well, often less than 5% of the target date funds assets are in alternatives. So why not? Why aren't target date funds embracing alternatives? Well, one of the things working against them has been high fees. And then the next table shows just to highlight that the multi-alternative category, which tends to be one of the more popular categories, has an average median expense ratio of 1.50%. Compare that to the target date fund average of what Susan went over, 0.71. It's more than double what the average target date fund the target date fund fee. So there's that definitely, with the sensitivity to fees with target date funds, it created made it difficult for alternatives to gain much traction. So alts haven't gained traction. So are there any other niche asset classes that have gained interest? And on the next slide, it shows that some categories have come in and out of vogue. Commodities have fallen off a little bit in terms of their exposure. So some target date managers have backed away. They're still in roughly 1/3 of the target date funds that in the universe. But one thing we have seen is that although emerging market debt, that category came down from 2015 to 2016 from 32% to 24%, we have seen an increase in emerging market debt local currency. So we have seen some managers like JP Morgan, MFS, and PIMCO add emerging market debt local currency to the mix. And this is an area, unlike alternatives, that we do see some emerging market debt is one of those areas we do see some large players participating in. Fidelity, T. Rowe Price, JP Morgan, TIAA, Kraft, they have exposure to emerging market debt. As I'm going to wrap it up, we're going to turn it back to Susan. So that kind of shows like what's changed has happened in the rear-view mirror looking at target date funds. But Susan's going to talk a little bit about what seems to be on the next frontier.
Thanks, Jeff. So to close out the presentation of the webinar, we'd just like to briefly touch on what's sort of next for retirement solutions. So in our meetings with target date managers and different asset allocation teams, we know that solving the retirement income challenge is top of mind. So we see that a few series here, American Funds, BlackRock, Fidelity, they have significant assets in target dates, and within recent years they've also launched retirement income products. But we can see, just kind of based on asset size, that managers haven't had as much success with these retirement income vehicles or even managed payout vehicles. And we also don't really see managers being willing to include these as sort of end of the glide path solution. So this is something we're certainly keeping an eye on, and we know that there are some new strategies that are coming to market and some strategies that are sort of revamping currently, and it's certainly something we'll be interested in sort of seeing how this evolves, because we sort of think that this will be kind of the next, nut to crack for asset managers going forward.
Okay, and so before we open it up to Q&A, again, you can submit them via the WebEx. A few things to highlight. I mean, we see target date funds continue to grow, and we don't see anything really stopping the target date fund growth, and that's continually changing the landscape. And so we expect the competitive landscape to continue to evolve. We expect that target date fund managers will continue to revisit and try to improve their target date offerings as they continue to research better ways to make these a better, to continue to improve as being a good way for investors to save for retirement. And with that, we'll open it up to questions. One of the questions that we saw is, can the divergence between target date series and target date managers be described by increased passive target date funds? And that is the case. That's one of the contributors to the increase of the number of series. Target date managers that came out with the active series initially have been willing to launch a series that invests in passive funds. And we've also seen it in a few instances where there's what you could call blend or hybrid versions of those series that blend active and passive. And again, there's a few reasons for that, and one of the reasons is to be cost effective, to keep costs down. So basically, when the target date fund managers, when they're revisiting their options, I mean, there's a couple ways they can create more series, and one of them is change the underlying holdings, and that could be by adding index funds or taking a different approach there, or it can be by switching the glide path. And we have seen some have actually launched different glide paths from one another, and that is covered in the full report. We do have a question on whether the CITs, collective investment trusts, are included in the report. So last year's report, we did highlight, we had a table that included collective investment trusts on some of the data we get here at Morningstar, and to get a sense of to round out the picture of incorporate that in addition to the mutual funds. For this year's report, it's stuck just to mutual funds. The reason being is the CIT funds, we collect that data, and it's a surveyed data, so we're reliant on asset managers to supply us with that data, and in many cases it's incomplete, and so we're working on improving that. And so we are cognizant with our target date in our discussions with target date managers of their CITs, and we're in conversations regarding those as well. And we hope to down the road be able to round out the full picture and be vehicle agnostic when evaluating the full target date landscape. Looking at other questions. There's a question that asking about evaluating target date funds and analyzing them, comparing them one versus another, and asking if we have any perspective on how to compare. We're constantly having meetings with target date managers to discuss their target date series, changes to their approach or team, or just get regular updates. One of the things that we'd point to that we find valuable is what we've displayed in Appendix 2 of the report, of understanding how target date funds differ from one another in terms of the sub-asset class exposures. Because what that can really do is help you set performance expectations as well as understand past performance, to not give credit due to largely a structural tailwind, like if an asset manager just happened to emphasize a certain asset class that did well recently. Understanding the sub-asset class glide path and understanding how it compares to average helps round out that picture. So that's something that we as a team focus on a bit in evaluating that. There is a question on related to fees on it, if there's an average fee that funds layer on top of the actual expense fee for the underlying funds. So maybe just a little bit of background on that.
Yeah, sure. So we don't have an average fee number available currently, just kind of to give you off the top of my head. But what we can say is that it's not every series charges a management fee on top of the underlying fund fees or sort of the 12B1 or other administrative fees. So it does just kind of vary from series to series, and that's not a number we have offhand right now. But again, it's not all series charge management fees.
Yeah, and I would say generally, so just putting that in context of history, so early on, I would say the commonplace was for target date managers to, because commonly they invest in underlying funds. So it would be the acquired fund fee with the expenses of the underlying funds, and they'd tack on an extra management fee for managing that. Being that a lot of them stuck to proprietary funds, there was some scrutiny on that and saying, like, you're getting the revenue from the underlying funds as well as the management fee. And so we saw the management fee for a lot of the larger target date series went away, and so they were just basically the expense ratio was just the acquired fund fee. There are still some series that do charge a management fee. The one trend we're actually seeing is that we're seeing the evolution of potentially going back to a management fee and just waiving underlying fund fees, and that could. And what that would do is give the target date manager more control over the fees. And so underlying fund changes wouldn't affect fees. Glide path changes wouldn't affect fees. So that is a potential area that we see some you could see come up down the road as well. There's a question if target date funds generally hold bonds to maturity or if they trade in and out of the bond portfolios. Generally, most target date funds hold underlying bond funds, and those bond funds are trade in and out of bonds. So most of them are a fund of funds again. There's some questions on alternatives. A couple questions on which type of alternatives are used and are REITs considered alternatives. And so to answer the REITs question, so we put REITs in commodities and other equities. So in like the sub-asset class glide path, in our reports, you'll see that other equity is primarily REITs exposure and commodities. Alternatives, which type of alternatives used? We typically, there's a full chart on, there's a full table in the exhibit in the full report that shows what type of alternatives are used. But it's usually a fund that falls in our multi-alternative category that has a variety of different alternative strategies, so like a global multi-strategy type of alternative strategies. There's a question about the growing trend in active passive blend offerings. We've seen those come to market within the last few years. It's appeared in some instances that they've been gaining some interest. In most cases, those have come from asset managers like JP Morgan or Principal that have a legacy in a predominantly active series. And so you still see most assets in their legacy series, but in some instances you are seeing interest, some positive flows into the active passive blend offerings. There's a question on the growth in multi-manager series. And touching on that, it's one of those things that we looked at, and as Susan mentioned, with the regression analysis of looking at open architecture versus closed architecture target date series to see if it's really reflective of whether open or closed has a significant advantage. And what we found is that it wasn't really clear that there was an advantage either way, just by being open or closed, or having a multi-manager, or sticking only to your proprietary funds. and what really is driving performance is really the equity exposure, as Susan mentioned. And the reason being, I mean, we cover a few target date series that have a multi-manager approach, and while it makes sense, why just pick the best managers and stick with them, and you'll have better performance. But the reality is that you have to pick the best managers, and you have to have the discipline to stick with them. And so in many instances, we see quite a bit of turnover in some of the multi-manager approaches. And so it's not clear and cut that multi-manager, just being multi-manager in and of itself doesn't give a target date series an inherent advantage over a series that could potentially have stronger underlying funds that are just run by their proprietary offerings. There's a question related to the process of the investor perspective on when it rolls over at the income phase. So target date investor, from an investor, you're in a fund. Let's say you start in a 2050 fund and you stick with it. Come 2050, what happens? Are you automatically rolled into an income fund? So there's a few things that can happen there. So some series don't actually have an income fund, so you'll stay, because they continue to glide many years, decades past the target date, so you'll stay in that 2050 fund decades after reaching the target date. But there are instances where, particularly with what are labeled as 2 series, where you're rolled into an income fund. That is the timing of it can vary. It's really up to the asset manager to make that transition happen. But the investor would basically be merged into the income fund at that point in those instances. There's a lot of good questions, and we're trying to get through as many as we can. We'll probably wrap it up with a couple last ones. There's a question as it relates to if firms that are seeing net outflows at the firm levels, they're seeing inflows at the target date funds. If they're seeing, or if those inflows are more the secondary offerings, not their flagship offerings. In some instances, there's a full exhibit in the report that shows for all the ones that have, all the target date series that have more than one offering. And it shows what the flows in 2016 were for those series. And you can see in some instances, like the Fidelity Freedom instance, like the Freedom Index series saw positive flows, whereas Fidelity Freedom saw negative flows. So it is a case by case. So for that question, I'd point to the full report. And just to make sure that it's clear, the report, we did publish it already on April 20th. It will be available for, you should be able to see a link with the webinar to download the report. And so you will be able to access it. And the final question we'll address is, have target date funds, has the increase in the equity exposure, is that explained by more funds using a through versus a to approach? And the to versus through hasn't been as much of a talking point of late in terms of when our discussions with target date managers. And so you don't see a lot of flip-flopping in terms of like going from to or through. And so it's more so because what we've seen is that increase in equity exposure came from both funds like the Fidelity Freedom ones that are through series, or the BlackRock LifePath Index, which is a to series. The increase in equity exposure has come from to and through. So I don't think that's a reflective of just a trend that through or to is, that through is gaining more interest than to. There's still a lot of those funds in both camps. And I guess I just highlight, in many cases, not all cases, but many cases, the to series, they're building those glide paths assuming that a target date investor would stick with that fund throughout retirement and hold it throughout the retirement phase, and they just keep that allocation steady. So it's not necessarily the assumption that that investor has to roll assets out and buy an annuity or something else. So I would just highlight that is that the 2 and 3 are still, neither one of them is becoming way more dominant than the other. They're coexisting, and the increase in equity exposure has largely come from both of them, and it's come largely in that mid-career investor. With that, we appreciate all your questions today. We're approaching the top of the hour, so we'd like to thank you. As always, feel free to reach out to us. We have included our contact information. Both Susan and I have our contact information included in the full report. If you have a specific question, feel free to reach out. We're happy to dig into these things.